Hi, welcome to the Lifetime Capital Gains Exemption in Canada video series. My name is John McElroy, and I will be walking you through the presentation today. We are on video number 6, Ongoing Purification. Ongoing purification, what does that mean? It means the prevention of the buildup of bad assets. In the last video, we talked about purifying at the time of sale and the kinds of problems that led to. So what if we just continually purified? How? To prevent cash buildup, we have 4 basic strategies. Number 1, regularly pay down liabilities. There's no tax consequences with that. It doesn't make sense when we're contemplating a capital gains exemption transaction to have any liabilities on our balance sheet if excess cash is a problem. We could invest in facility and equipment, no tax consequences. We covered both of these in the last video. Pay shareholder dividends. If we have excess cash, we could pay it up to the shareholders. The only problem is that's taxable in the hands of the shareholders. If we had a Holdco structure, we could pay an intercorporate dividend to the Holdco. It's usually tax-free to a Holdco. But that doesn't necessarily solve the problem. Let's look at the OpCo-Holdco structure. If you own shares in the operating company directly, or if you own shares in an operating company through a Holdco, let's look at the 2 different scenarios. If we wanted to undertake purification and we owned the OpCo directly, let's say we had $700,000 worth of cash and the working capital requirement was $200,000 and we had excess cash of $500,000, and that was considered to be not used principally in the active business, we got to figure out what to do with that $500,000. Does it cause the OpCo to fail the asset test in terms of 90% of the fair market values of the assets being used principally in an active business? Is it a bad asset? Well, we have to check. Let's say the fair market value of all the assets were $2.5 million. The excess cash was $500,000. That's 20%. Is this a problem? Yeah, of course it is. Because if the excess cash represents 20% of the fair market value of the assets not used principally in an active business, we're going to flunk the test. We can't have that $500,000 of excess cash sitting in the company. That excess cash is considered a bad asset. And for QSBC purposes, it has to be removed. So I could pay a dividend up to the shareholder. You could pay yourself a dividend to prevent the cash from building up. If you paid that dividend regularly, you'd have ongoing purification, but the big problem, of course, is that dividend is going to be fully taxable, and for that reason, not the preferred solution. So some people will interpose a Holdco between themselves and the operating company. Now in the same scenario with $500,000 of excess cash in the OpCo, we can pay an intercorporate dividend to the Holdco, and that intercorporate dividend under Section 112 of the Act is usually tax-free, which is a way to purify the Holdco. But that doesn't necessarily help us because now we have a buildup of bad assets in the Holdco. And we do have to sell the shares of the Holdco because, of course, the Holdco wouldn't qualify for the capital gains exemption if it sold the OpCo. Both companies have to be sold. So basically, we fail the asset test by having too many bad assets in the Holdco. So the next question is, what if the Holdco invested its cash? It received the intercorporate dividend, then it took the $500,000 and invested in a second operating company. Well, using the Holdco still doesn't work that well, even if all 3 companies are purified. You purified the Holdco, you purified the OpCo, and you purified the second OpCo. Because even if all 3 tests are met for QSBC purposes, it's pretty hard to sell the Holdco with this kind of a structure. Buyer does not want to own multiple companies. So additional restructuring might be required, and for that reason, we don't consider it to be the preferred solution. There is a better option than ongoing purification, And we're going to take a look at that in the next video. I'm John McElroy. My number is 905-267-1043. I hope you're enjoying this series on the Lifetime Capital Gains Exemption. We're going into a lot of detail, but hopefully it's useful. And we will see you in the next video.